Hi, my name is Tart, and I am currently the SFMC graduate assistant here in the Olinde Career Center. And so let's go ahead and get started with the second part of our credit series informational. So just for a refresher, credit refers to a contractual agreement to purchase a good or service with the express promise to pay for it later. And so credit works as a measure of trust between two parties entering a financial agreement. Credit is super important, super important because it can grant you better job opportunities, more apartment and housing choices, lower interest rates on borrowing, access to premier banking services, and fast loan decisions. However, we have credit's opposite, the debit. And so a debit, specifically a bank debit, is a bookkeeping term for the reduction of funds held by bank customers. And so when your bank account is debited, money is taken out of the account. And so your account is debited in many instances. For example, if you set up a direct debit, which is like online bill pay or automatic bill paying, and your money is when your money is automatically taken out of your account. Um, Also, when you write a check and it's cash, or when you use a debit card, which enables you to take money out of your bank account and use it to purchase goods and services. And so, the big difference between a credit and a debit is that basically a debit is you're spending your own money, and a credit is when you're borrowing money. And so these are just some need to know terms right here. I'm going to quickly go through all of them. If you have pen and paper, I would recommend taking notes during this section, or you can always go back, rewind, and refamiliarize yourself with the terms. And so, an annual fee is most common with credit cards for bad credit and travel or credit cards. And so, basically, it's just a fee that you'll pay every year for having the credit card. Depending on the credit card, you may not have to pay an annual fee for the first year that you own it. An annual percentage rate or an APR refers to the annual rate of interest charged to borrowers and that money is then paid to investors or credit agencies. You would use your APR to compare competing loans with each other so you can understand the full cost of the loan, including the interest, and determine which loan is best for you. The balance transfer is the process of moving some of all of your balance from one credit card to another. And so people usually do this because they want to take advantage of a 0% APR promotion. And so that 0% APR promotion is also up to the credit card issuer, who it could be a bank, a credit union, or another financial institution that services credit cards accounts. These are not to be confused with the term payment networks, which we will talk about in a few minutes. So a credit limit is the total amount you charge to a credit card. Let's say, for instance, your credit card has a limit of 500. You cannot charge more to the credit card than $500. The size of your credit limit depends on several factors, including the type of card, your credit worthiness, your income, and your overall debt load. Your credit utilization rate is just your credit card balance divided by your credit limit. This is a very important factor in determining your credit score. Um, if you see any problems on your credit score, you are able to dispute an unauthorized transaction or disagree with the charge on your statement. The, your issuer usually has two billing cycles to resolve the dispute. In the meantime, you will receive a temporary credit for the disputed amount if you accurately dispute the right amount. The EMV chip, that's the chip that has been added to our debit cards in order to provide an extra measure of safety when using our cards in public. These chips push out a transaction code that is for one-time use only. So every time you swipe your code, it produces a new transaction code that makes it harder for your accounts to be hacked. A grace period is just the time between the closing of your billing cycle and your due date. Um, of your payment. And so basically, you can pay off new purchases without accruing any interest during this grace period. And a grace period, um, because of the Card Act in 2009, it requires that a grace period be at least 21 days. A late payment is just that if you do not pay the minimum amount by your due date, your payment is considered late. And so many issuers do charge late fees. And if your payment is more than 30 days late, it can negatively impact your credit score. And then the minimum payment is just the lowest amount you're required to pay each month on your credit card without incurring a late fee. And so, basically, making your minimum payment will make sure that you keep your credit account open, but you want to make sure that you pay off every balance within 30 days. Um, your payment history is the most important factor in your credit score. We talked about this a lot in the past presentation. But your payment history is what creditors see if they want to make sure that you're trustworthy or when borrowing their money. So you can even take it one step further and pay off the balance in full to make sure you avoid interest. The payment network different from the credit card issuer. The payment network is their primary business is processing the transactions that happen in your credit card. And so Visa, Mastercard, Discover, and American Express are the four main payment networks in the United States. But it's also important to know that Discover and American Express are also credit card issuers, as well as Visa and Mastercard can also be used as credit cards through independent companies. Your valuable variable interest rates uh, just state that mainly interest rates change depending on your credit history and your relationship with the credit card issuer. The prime rate, which your APR is based on, it just fluctuates based on federal funds or based on the economy at the time. So basically, this interest rate does vary due to a lot of external factors. And then you have your 0% APR, which means that you don't pay any interest within a set period of time. And if you don't pay off the balance before the promotion ends, you'll owe interest on whatever is left over. So let's say, for instance, um, your credit card company gave you a 0% APR for the first year having it, and so that means that you will not be charged any interest for that first year. But if you have any balance left over on your credit card after that first year, then you will be charged interest on whatever balance that you have left over. All right. So let's dive into the difference between credit and debit cards using those terms that we just discussed. And so the major differences between a debit and a credit card, we're going to start with the debit card. So a debit card is tied directly to your checking account, which means that you're spending your own money. A debit card can be used wherever a credit card can be used. With your debit card, you'll actually use a personal identification number or a PIN number to complete the transactions. It's usually a four-digit number that you would enter into the keypad. And then a debit card is also good for daily use to help you stay within your budget. And so choosing a debit, choosing debit when you're swiping the card can help you make complete the transaction faster. It can help you save the merchant money. It could offer you more cardholder benefits, but however, choosing credit when swiping your debit card will not help you build credit. And so major differences between a debit and a credit card, specifically credit this time, is that your credit card gives you access to a line of credit, a specific line of credit that you have opened that allows you to borrow money and which you will have to pay back. The purchases usually require signatures. If your purchase is less than $25, you probably won't have to use a signature, but a credit card purchase typically requires a signature. You pay interest if balance is not paid off in 30 days. So basically, if you charge the amount to the card, as long as you paid it off within 30 days, that money is not charged interest. And you also can use hotel reservations, credit cards for hotel reservations and car rentals. And so, just furthermore, with a debit card, you only can spend the amount that's in your account. So that's what is meant by pay by real time. Using a debit card can help you avoid unnecessary spending, track your spending, and budget with your cash in your account. And most debit cards won't offer rewards since you are spending your own money, but some do. And so it's just important to make sure that when you're picking the right banking institution, financial institution, that you are looking for some that benefits you in the long run. In return, with credit, you can spend or borrow up to your credit limit as long as you agree to pay it back later. A credit card can help you build credit. It can help you maximize your rewards, and you also get purchase protection, which means that if you pay for a good or a service, and that good or service is not delivered or you do not receive it, you do have payment protection, which means that your payment will be returned to you because you have no tangible or intangible benefit from spending your using a credit card. And also, most credit card offer rewards, typically in the form of cash back, which means that they give you about 1% of the money that you spend yearly back to you in one lump sum amount. But you can redeem these for your cash back, or you can redeem for other merchandise like gift cards or flights, just depending on which credit card or financial institution that you choose to involve yourself with. And so now we're about to do a little activity. If you can pull out a sheet of paper, we're about to go shopping for the best credit card based on the terms that we just discussed. And so, using this, you're going to shop for the best for the credit card with the best annual fee, with the best APR, and with the best rewards program. So you don't charge perishable items to credit cards, and you pay off as much as possible every month. So let's look over here at the chart. Let's say, for instance, we have a balance of $3,000, and the card has an interest rate of 18%. So if you pay off 2% of your balance each month, you would be charged about almost $8,000 in interest, in which it would take you 37 years and 7 months to pay off that $3,000 balance. If you pay out 4% of the balance every month, you will only be charged $1,716 in interest, which will take you about 10 years and 10 months to pay off the amount balance right there. And if you agree to pay off 5% of your balance every month, you only pay about $1,200, roughly $1,200 in interest, and it'll only take you 8 years and 4 months to pay off that balance. This is a really, really high interest rate, and so you'll notice in this example how much less interest you pay at the 4% minimum than when you pay the minimum payment is at 2%. Repaying the balance still takes over 10 years, but if you can pay more than the minimum monthly payment, you can decrease the amount of interest paid and the number of years it would take you to pay off the debt. So paying more actually benefits you. Paying only the minimum payment will make you pay over twice as much as the original balance in interest. So it's important to remember that the more you pay, the less you end up having to pay in the long run. And so scams and credit card safety is very important, especially for college students, as college students are mostly targeted for our credit card schemes and credit card and our credit lenders and everything. And so the most common credit card mistakes college students can make is they overspend, they hold way too many credit cards, they only make the minimum payment, they assume low interest rates stay the same, so that 0% APR, it is an assumption that carries over into the next year when it usually doesn't. They pay a higher interest rate than necessary. And not reading the disclosure statement, you must read your disclosure statement, which is included when you sign up for your credit card. It gives you every single piece of information that you would need when making purchases or paying back the money that you borrow. And also ignoring extra fees or penalties. So making sure that reading that disclosure statement usually lists out those extra fees and penalties. So making sure that you are budgeting those into the amount that you pay back. And so credit card fraud is just it's an unauthorized use of credit or a debit card. It's similar to a payment tool, um, or just using it to fraudulently obtain money or profit. So basically, someone can obtain your number from unsecured websites, or just leaving your card number exposed, or it can be obtaining an identity theft scheme. And so, most credit cards offer protection. Um, and this goes back to that payment protection where credit cards promises you if you are a victim of fraud, credit cards promises you that money will not be held against you in your credit history. However, with debit cards and financial institutions, only a certain amount of money is covered under the federal guidelines that banking institutions have to are governed by. So these are just some tips to avoid credit card fraud. Don't give out your credit card number online unless the site is secure and reputable. So what you'll look for, it'll be a lock icon near the address bar of the website that you're visiting. If that lock is not there, do not enter any payment information. And even if the lock is there, it doesn't mean that the website will protect your information. It just means that there is an extra layer of security to make sure that you are visiting a safe website and that your information is safe. And so that goes back to don't trust a site just because it claims to be secure. Sites can list anything, but you want to make sure that the site is secure before you input any payment information. Before using the site, make sure you check out the security and encryption software it uses. You usually can do that by scrolling to the bottom or looking for that icon in the top near your address bar. Making sure you're purchasing merchandise from a reputable source. If you know someone that has used the website before and they actually receive their goods or services, by all means, go ahead and try it out. But if this is something that you have never done before, if someone you know has never done before, and you just feel a little uneasy about purchasing from this website or purchasing from this person, usually your gut is going to tell you that you're right and you should not purchase if you're uncomfortable with inputting your information on this website because usually those aren't trusted sources. Also, be careful with social media boutiques and everything because sometimes those can also be scams. And make sure you do your homework on the individual company to ensure that they are legitimate. Goes back to the Instagram, boutiques, Facebook Marketplace. Make sure that you are doing your homework. Make sure that you are being safe when you purchase items or when you input your financial. Basically, you're financially committed to purchasing an item, but the item might not even be real. So you want to make sure that you have all the information that you have about the individual or the company that you're purchasing from, just to make sure you are being safe with your purchases. And then a few credit card management tips. So, as if you lose, make sure you store your credit card in a safe space. And if you lose it, report it stolen or lost or stolen immediately. And so, the Fair Credit Billing Act limits liability on your credit card to $50. Um, Make sure the same goes for lost check cards or ATM cards, debit cards. If you report one loss of stolen within 2 to 60 days, your liability goes up to $500. If you don't report a lost and stolen check or ATM card within 60 days, you can face unlimited liability for your unauthorized use. So what this means, what this means is that if you do not report that your car was lost or stolen immediately as you if you lost it or stole it, and money is missing from your account, then really the Fair Credit Billing Act limits creditors from excusing you from all of their debt just because it is your responsibility to report it lost or stolen. Also, if you lose your credit card or debit card, track your charges, look at your statements, make sure that you completed all of the charges that are records on your account. Document all of your concerns in writing to your creditors. Creditors check your statement every month. Lenders and creditors can make mistakes, and so if you write to them, you can get those errors corrected, and these transactions will be corrected also in your credit report. And also talk to your creditor. Ask them to lower your credit limit if you feel like you reach your limit too much or you spend too much money, or ask them to change when your bill is due if you think that the date that the bill is due, just falls in a very tough place for you financially within a month. Um, if you have any questions, please feel free to direct them. I would love to answer them. Here's my contact information. My office is located on the first floor of the Union near the ATMs. You also can schedule an appointment to talk with us. Just follow our website at lsu.edu/sfmc. Or if you have any directions, you can email them directly to me. My email is careersynergy86@lsu.edu. It's been a pleasure presenting this to you, and as always, go Tigers.